Okay, well, without any further ado, let's kickstart the Money Show then and introduce Shweta Jain of Investography. Shweta, hi, good evening, and thank you so much for taking our time and joining us today on ET Now. So, for the most part of last year, the unit holders, especially the ones who invested just before we got into the pandemic and the first lockdown, saw quite a nice merry ride. Mid caps were rallying, small caps were rallying, so that's the reason why their funds as well saw a nice uptick. And many investors too recognize this. That's why if we look at the AMFI data, month after month, there were net inflows into mid and small cap funds, and it kept increasing. So investors as well said that, okay, mid and small caps are in the momentum, so let me dive in over here. The last couple of days though, the news flow has kind of changed. It's not been that great. How do you read into mid and small caps?
Hi, Mubina. First of all, thank you for having me on the show. It's always a pleasure chatting with you. So mid and small cap, as you rightly said, has generated interest because of how it has performed. In fact, there are funds that have given over 100% return in the last 1 year. And seeing as investors, we want to see the recent past performance and then invest rather than look at our goals or look at our asset allocation and invest. So people have invested looking at the recent track record, and which is why when we see the volatility in the last 1 week, 15 days, it baffles a lot of us because we've only seen the good times, so to speak, because markets have done, especially small and mid cap, have done fantastically over the last 1 year. So I would urge investors to look at their asset allocation and ensure that if there are new investors, they come into large cap first, experience some bit of volatility because markets have spoiled us in the last 1 year. Newcomers in the market, whatever their age may be, they have thought that, equity is a one-way ride, which is up and up. So which is why we need to make sure that in volatility like this, investors should be able to stomach it, should have the ability to stomach it and the appetite to stomach it as well. They are just true to their nature, mid cap and small cap. They are more volatile than their regular counterparts, which is large cap. So they are being true to their nature, which is volatility.
In fact, you spoke a little bit about it, about the volatility and how investors must stomach it. So, the fact that there are such swings, how is it more risky then for investors compared to maybe an index fund or a large cap fund, a mid and a small cap fund? Where in the riskometer would you place that?
Oh, definitely. It's definitely riskier than your index funds and your large cap funds because the large cap funds have the bigger companies, right? So the volatility there is far lesser than small and mid cap companies. If you see, in fact, there are small cap and mid cap companies which will be far more volatile than anything in the large cap segment. Small cap especially will be very, very volatile. In fact, when we talk about equity time horizon, if I talk about large cap, I say, even a 3 to 5 year time horizon is good, is long term. But for a small cap, you have to consider a 7-year time horizon, nothing less than that, because that is how much time you will take to make sure that, your volatility is evened out, that you're getting good returns. Unfortunately, markets are, like I said, have spoiled us in the last 1 year. So people think, large cap and mid cap and small cap, they're all similar performing stocks and segments, which it isn't.
Okay, so this is something I guess that we really have to deal with. You must know that it is a common phenomena to see this massive volatility come by in mid and small cap indices and stocks, and thus in the funds as well that you own. Now, how if there's so much volatility in mid and small cap funds, it can be difficult to assess the performance. It's very easy to say that, between March 2020 and now, some small cap funds have given 100% return and so on and so forth. But then you look at the period before that, for those investors who put money in mid and small cap funds in 2017, they're not going to be very happy, really, because those 2-3 years, it was negative returns. So how do you review the performance of mid and small cap funds that you own in your portfolio?
I think it's unfair for us to say that small and mid cap should perform every year. As an asset class, They will never be performing in a linear fashion. That's the nature of this asset class. So there will be periods of volatility, which is why in the beginning, say 17, 18, 19, if you see, even if there is negative or no performance, the last 1 year has more than made up for it. Why are investors unhappy? Because they see similar returns getting by people who've invested just last year. So that comparison is making them more unhappy than anything else. So I would urge people, when they're looking at small cap funds and mid cap funds, they should look at the portfolio segmentation, saying, okay, what is the portfolio allocation? In which sector is the portfolio being invested? Is it heavily concentrated? Is it properly diversified? So they have to look at some of these factors. Plus, they have to be inward looking and see their asset allocation and their goals, and see when do they need this money back. If they can stay invested in times like this, also they should ride out the volatility, because this is an asset class, this is a segment which will do well. They have to meditate, they have to breathe this volatility and make sure that they can stay. If they can't stay invested, however, if they have goals, then I would recommend people that they don't invest in a small and mid cap if they have any lesser time horizon than, say, 5 to 7 years. That is the bare minimum I would recommend for a small and mid cap fund.
Right now, if investors, I mean, looking, if you have a certain outlook on how you expect small and mid cap stocks to do, right now for investors already holding units in mid and small cap funds, what do you recommend they do? And I'm going to put forward two scenarios. One, somebody who has a long-term time horizon, who can keep their money in these funds they have invested in for general wealth creation purposes. And second, somebody who perhaps anticipates that, okay, maybe 3-4 years later I would need this money, or maybe even earlier for that matter.
So somebody who has the time horizon, I would definitely say just stay invested. Ignore the noise. That's the only thing I can do. Meditate and breathe. Ignore the noise all around. For somebody who has 3 to 5 years, 4 years horizon and cannot look at volatility, I would say it's a good time to exit. You don't have to stay invested and lose your sleep over this. There is a balance that needs to be brought out. So, if the returns can be made by investing in good large cap companies as well, in good large cap mutual funds as well. So you don't have to take that volatility that comes with small and mid cap. So I would say if you have a time horizon of 3 years or lesser, definitely don't look at a small cap. Just because the tax segment says equity is 1 year as long term, we don't have to look at it that way. We in fact should look at equity as 5+ year time horizon.
All right. Well, there you have it. That's, on how you can approach mid and small cap funds and how you can go about investing in them. This is not something that is a one size fits all. You have to look at your own risk profile as well. And like Shweta said, you must have the stomach to invest in mid and small cap funds. Such volatility is a part. So, Shweta, if I as an investor wanted to include mid and small cap funds in my portfolio, not me, in fact, I would like you to share this for different age cohorts. Someone who's younger, maybe in their 20s, somebody middle-aged in their 40s, and someone who's approaching retirement. How would you recommend as a percentage of the overall equity MF portfolio one should put in mid and small cap funds?
Okay, so I don't follow the age funda at all. In fact, I look at it a little differently. I look at it like being like a new investor versus an old investor in equity. For example, if you're a new investor in equities, a very high percentage in large cap or maybe entirely in large cap, after a few years, maybe start looking at mid and small cap. Don't look at it as missing out on something. If you've been investing for a few years, then you can definitely have, say, a 15 to 20% in mid and small cap segment. The more experienced the investor is, usually he also has more money. So maybe then increase your small cap allocation as well to like a 30-35% as well. Your time horizon not necessarily reduces with age. In fact, if you see the younger you are, you will need monies for various other goals also, right? Whether it's buying a house, buying a car, children. And as you get older, you may have larger chunks of money and you may also have the appetite You may have goals which are further off. Like even if somebody's retired, they don't need everything today, right? They can stay invested for many, many years, for 20 years, 25 years, they can stay invested in equities apart from their cash flow. So I would look at it like that, the experience of the investor rather than age, because I have seen that, newer investors in their early 20s, they have this whole target that they will invest, but because they need the money, they keep withdrawing. Say they want to take a sabbatical, they want to take vacations, so all sorts of expenses crop up and they do this. So I would recommend that look at your experience and then allocate towards large and mid cap.
Okay, so that's of course about how you can go about investing in mid and small cap funds. Shweta has a different approach. She does not necessarily go by the whole funda of what your age is. There are many other factors as well to consider. Fair enough, like Shweta has shared with us. Okay, you know what, I'm going to do one thing. I'm going to now invite some questions and queries from our viewers. Remember, folks, if you'd like to connect with Shweta and our guests, write into us. Our email address is themoneyshow@etnow.tv. So for now, I'm going to take on board some questions that have already come. Our first question is from Tushar Y. He says, I want to invest 20 lakh rupees in the multi-asset allocation fund because equity has run up too much and I'm not sure where to invest in debt. Do you think I can invest in lump sum? And he also, throws some options of the fund houses which have multi-asset funds. So Motilal Oswal, SBI. And he also says he does not need this amount for 5 years. So fair enough, he does not understand much about debt and he's also afraid about the kind of run-up in equities. In such a situation, where do you recommend individuals like Tushar to invest?
So debt is actually a trickier place right now than equity. So I would definitely recommend that if he wants to separate these funds out, he can look at that. He can look at floater funds or short-term debt funds, and he can look at pure equity funds like large cap. He could look at a ICICI Nifty Next 50, for example, if he wants to do that. Or he could look at multi-asset funds where he can get that exposure at one place and stay invested for the time horizon, like you mentioned, right? 5 years. So he can just do a lump sum and stay invested. I would recommend an SBI multi-asset and an ICICI multi-asset fund, a combination of the two. I think a good balance, a good diversification in various ways, and a good amount of return is what he can look forward to. I think it could be a good combination for him.
Okay, so that's the recommendation coming in from Shweta on how you can go about that. Let's take on board our next query then. This one is coming in from Minal Singh. Minal says, if I have a view based on my readings of the economy and a news flow that a particular sector will benefit, but I'm not sure of what stocks within that sector, would a thematic ETF be a good choice for me? Kindly share your views on my thinking along with the pros and cons of thematic funds. Okay, very interesting question. In this case, Minal has a lot of conviction that a particular sector is going to do well. But, within that sector, there are so many stocks. Sometimes those stocks can have divergent views depending on what the news flow is. So is Minal right then in choosing a thematic fund? Is a thematic fund meant for individuals like him?
So I don't recommend thematic funds at all. In fact, so that is my sort of bias here, because I do believe that we can't get both entry and exit right, and in a thematic fund, both become very, very important, right? So we can't get these right. We either get in too late or we get out too early or too late, and it could be a disaster. So whatever, if I would say, if he has this money for gambling, that's the money he should be putting in thematic funds, being as crude as that. But if there is a certain sector that's doing well, rest assured, fund managers are definitely following it. They would have probably highlighted it or got it highlighted to them even before you and I could see it. So these would be in a diversified equity portfolio as well. So I would rather take risks within that diversified equity portfolio rather than take thematic funds, unless he wants bragging rights that, I invested in a pharma fund before everybody else got in and, I booked so much profit. I mean, unless it's for bragging rights, then it's fine. But I definitely wouldn't recommend this to an investor.
Okay. Understood. So not exactly a fan really of, thematic investing, regardless of, however convinced you are, when it comes to thematic funds, it's all about timing. Just a case in point, pharma was all the buzz in this last 1 year, obviously because we were in a health crisis, and now look at it, in the last 3-4 weeks, pharma has been falling. So if you had invested in a thematic fund, in a pharma fund a month ago, you would not really be happy. So there are a lot of timing issues involved with thematic funds, and that's the reason why for Shweta it's a strict no. Okay, Srini Rajagopalan says, I would like to make an investment of 50,000 rupees in an ELSS scheme to avail exemption under Section 80C. I've shortlisted 3 schemes to invest and would like your expert opinion to select one of the funds. DSP Tax Saver, BOI AXA Tax Advantage and Quant Tax Plan. Kindly recommend. Shweta, how would you go about choosing an ELSS scheme?
So I would definitely look at 3-year track record for sure, but even a longer term rolling returns is something that you should be looking at. Look at the composition of the portfolio. I would recommend a DSP tax here when I'm comparing these 3. If it's a 50,000 and if this is going to be an annual sort of affair, which it should, then I would say she could even split it between, say, a DSP tax and an IDFC tax. She'd get a good combination and a good diversified portfolio.
All right, I think that's all the time we have for questions and queries. Shweta, thank you so much for joining us and patiently answering our viewers' queries as well. Thanks once again.
Thanks so much for having me.